Real talk, the IRS is never going to call you and say, hey man, you forgot to claim these deductions, please amend your taxes and get a refund. That's just not their job. That's my job. There is a retirement account out there, totally legal, fully approved by the IRS, that lets you write off up to $70,000 a year. Put the money in this account and get the deduction today. So if you are about to file a tax return for 2025 and on form 1040, go look at line 20A, and if that line is blank, you don't have anything on that form, then this video is going to show you exactly what you need to do right now before you file your taxes, before you sign your returns. This information should have been available to you from your CPA who does your taxes, but if you don't have this information, then we are going to discuss what this retirement account is applicable to you and what can you take advantage of out of these accounts and how much money you can deduct from your taxable income and how it can benefit you. So you worked hard the last year, you made real money, and then when April comes around and you feel like the IRS has been working just as hard to take that money back from you. Sounds familiar, right? Well, what if I tell you there is a complete legal way for you to keep that money even if you haven't made that transaction in the previous year? Just put your money into that account and it is a write-off. No loophole, no shady stuff, just a retirement account that most business owners are completely ignoring. Let's fix this. Let me tell you a little bit about me. My name is Dhiren. I'm a co-founder of D2 Tax, and we are an accounting firm that works primarily with investors and business owners. People we work with are generally the ones that are running multiple LLCs, S corporations, partnerships, you name it, complex stuff, the kind of stuff that makes a regular CPA sweat. And the number one thing that we see year over year is people leaving thousands of dollars on the table every single year because nobody told them about these two retirement accounts. So today I'm going to go over these retirement accounts, and you might want to take some notes from this video because this is going to be a very detailed video and you'll have to see what's applicable to you. Everything here is general information. Your situation can be unique. Talk to your CPA or your accountant and have a real conversation about what applies to you, what deductions are actually applicable to you. So this is just educational, general information, but it's a good one to pay attention to. So two accounts you need to know about are the SEP IRA and SOL 401k. Fancy names, but very simple ideas. Basically, the government is saying, hey, if you set aside some money for retirement, we will let you deduct it right now. You pay less taxes today and the money grows tax-free inside this account. And we will deal with the taxes later on when you retire. Simple. And hopefully this will help you lower your tax bill. It's basically the government's way of saying, we will give you a discount today if you promise to save money for your tomorrow. And unlike most government offers, this one is actually good. The limits on these accounts are actually pretty generous, up to $70,000 or $75,000 in a single year. This is not a small pocket change. This is some serious deductions. So SEP IRA or SOL 401k, which one's going to be the best option for you? Well, let's talk about SEP IRA. It is the easiest one and simplest one to set up. Not much of a paperwork, works for almost every business type. But the catch is, if you have any employees on your payroll, whatever percentage of amount you decide to put it aside for your retirement account for yourself, you're gonna also have to do the same percentage of amount for your employees. Something to think about. And number two is SOL 401k. It is primarily for somebody who is flying solo. You or maybe your wife working together in a business and you have no other employees. But this one actually has superpower, and it has two contribution buckets, one as an employee and one as an employer. And you stack them together and you can often contribute more money than a SEP IRA would allow you to do, especially if your income isn't sky high. Basically, two bites of the same apple. And the IRS is the apple, which feels great. Now your business type changes how this would work. So let me give you a quick version of each one of them. SOL 401k or single member LLCs. Your contribution is based on your net profit after all the adjustments. Your accountant is going to run that number and calculate that for you. So don't try to eyeball it. But yeah, you can use both of these accounts. They'll work great for you. For S corporation owners though, here's the thing people miss. So your contributions basically depend on the S corporation on your W2 income, not the total income that flows through into your entity. Your CPA should be able to find that information for you. But for C corporation owners, salary-based contributions, the company that deducts the contributions before income even hits the corporation tax return, clean way to put that money out of the corporations without getting hit twice on the taxes. Partnerships or multi-member LLCs, each partner has to handle their own retirement account individually based on their share of the income. But the business actually does not set it up for everyone. Each person does their own themselves inside the partnerships. Easy to miss, easy to fix, and easy to mess up. But if you know it, you can fix it. But what about the bad years, right? Maybe this year wasn't your best year. Things happened, deals fell through, property sat empty, partnerships got complicated, and life in general. So in that case, what most people do when they have a bad year is they just assume that retirement accounts contributions are just off the table, and then they move on, and then they pay full tax on whatever income they did had. Here's what they should be doing instead. Even a small amount of retirement contribution in a down year will still save you real money, because a deduction at a 32 or a 37% tax bracket is not a small one. And here's the part nobody tells you. A SEP IRA, you can open it and fund it all the way until the tax deadline, including extensions, which means all the way to October in some cases, which means if you are on an extension, that window might be open right now. Go check with your accountant. Now, if you're watching this and thinking, okay, I want D2 tax to handle this for me because it does sound a lot more complicated. Well, amazing. But we have a problem. Let me tell you exactly how we work so there is no surprises. We are not a drop-in shop. We don't take you on a Monday and file by Friday. We take the time to understand your full picture, all your entities, all your income, and all your goals before we touch anything. So here's the real talk on timing. If you come to us this week, before April 15 and you ask us to file your return on time, the honest answer is going to be probably not. Not because we don't want to help you, but because of our clients who plan ahead of time, sent in their documents months ago. They are already in a queue and they showed up first, they go first. And there is a million reasons why we have to take care of them first. What we can do is within first 30 to 60 days after we file extension for you, we can take care of your taxes. We can take our time, we can find each deductions you are entitled to, and we can do it right now. We can start right now, we can work on that right now. Extensions are not really scary. We file them all the time for mostly all of our customers. Extensions are just strategies. Reach out to us now and get on the radar early. Look, the IRS is not going to call you and remind you about any of the deductions that you have been missing on. That's not really their thing. That's our thing. If you had an LLC, a S corporation, a C corporation, or you're just running a show all on your own, there is a very good chance that you have a retirement account contribution option that you have not been using. Talk to your CPA about it. Ask them about the SEP IRA or the sole 401k. Ask them which one fits your entity better. Ask them which one works better for you. And if you don't have a CPA, well, you know how to get hold of us. You know where to find us. My name is Dhiren with D2 Tax. We'll see you guys on the next one.